All right, good evening, everyone. Welcome. Thank you for coming. It's admirable that you're out here late learning about these topics for your kids and grandkids, and I'm sure they'll appreciate it someday. They may not appreciate it now, but I'm sure someday they will. So this is going to be a great presentation. First, I'd like to introduce our co-sponsors. My name's Joe Iyer. I'm with the Los Altos Community Foundation. We've been around since 1991, and we're all about trying to make our community a better place and a more philanthropic place and a greater place to live. So we provide a number of services, grants, programs, funds, and so forth. To my immediate left is Laura Roberts. She is the co-ED of the Mountain View Los Altos High School Foundation, and they are all about raising money to improve the high schools, and so they're doing a great job there. And then finally, Heather McDonald, she's the Executive Director of Los Altos Education Foundation. They got their little banners over there. And of course, they're focused on the Los Altos School District, the K through 8 local school district. So they're doing a great job raising millions of dollars for the schools so that they can have better programs, smaller class sizes, and just a better educational experience for the kids.
Okay, so most presenters start with a joke, attorneys start with a disclaimer. The disclaimer is that we're all going to share a lot of information with you tonight, and you shouldn't rely on any of it. You should get ideas, and then you should go and talk to your advisor to get specific information for your situation. We can only provide general information, and every situation is different. So the information we're providing is for California residents who are U.S. citizens. The topics we're going to cover tonight are giving to individuals, kids, grandkids, and charities. We're going to be talking about saving for college, helping pay for college, how to help buy a residence or transfer a residence. We'll talk about just giving to kids and grandkids in general, and we'll talk about ways to give to charities. So the first thing with giving is, what can you afford to give? So I do estate planning and tax work, and a lot of people come into my office and they've heard about some change in tax legislation, and they think they need to do tax planning and start giving. And then we look and we think, okay, this is an appreciating asset. We want to get the appreciation out of your estate, and we want to save taxes. That's all really great. But this is an asset that's kicking off cash flow that you're living off of. Can you afford to give it away? And then we get sort of a blank look. Well, we don't really know. So we work as a team. I can prepare the documents to do the transfers. I can advise you on the tax work. Lonnie and Dennis can advise you on the tax issues. But in terms of whether you can afford and how much you can afford to give away, that's a financial planner question. And financial planners can run through what is the cash flow that you need to live on, looking at what do you think the return is that you're getting on your investments, what is your life expectancy, all of those things to figure out a number that you can feel comfortable with giving. Because the first thing, we want to make sure that you haven't given away too much. And then next, with the charitable component, what is your legacy? So with my kids are 6 and 8. So I'm teaching them now about the 10% savings, 10% to charity, and the rest is the spending money. And I'm trying to convey that this is an important message, that we look at how we allocate our money. But then if in my estate plan I just leave everything to the kids, then have I somehow diluted that message? And so should I be thinking about what am I saying in my estate plan as a message to my kids in terms of what component charity is in my giving? And also, if I have regularly supported a particular charity over my lifetime, and I haven't set up some kind of way for that to continue after I'm gone, then what's going to happen to that charity that might have been counting on me being a regular donor? So, so the first thing we're going to talk about is gifting to minors, so kids that are under 18 and cannot have title to assets in their own name, and how we save for college when we want to put some money aside for them, but they're not old enough to have an account yet. So Uniform Transfers to Minors Act is a way to set up an account for kids that are under 18. Trusts are a way, 529. Life insurance is an idea that you buy life insurance on the kid's life because it's really cheap when you have a very young child, and that builds up some cash value that then you can later use for college. The decision on like 529 plans versus life insurance, I would say, is a financial planner question. Some will say that life insurance doesn't turn out to be the best financial planning, that either setting up money in a UTMA account, the Uniform Transfers to Minors, putting money away in a trust, putting money in a 529 plan are the ways to go. We'll also touch on setting up custodial Roth IRAs for minors to help encourage them to save money, and then doing Roth conversions. For grandparents, there's an extra couple of planning ideas for them where you grandparents can pay tuition and medical expenses directly. I didn't have this on the parent side because really that's an obligation that the parents have anyway, so it's not really gifting, it's just satisfying their requirement. So how does the IRS fit into gifting? I was told that if I talked too much about taxes at 7:30 at night that you'd all be asleep. So I have one slide on this to tell you that the IRS wants to know when you gift. They want to know when you've made a gift because they want to tax whatever you have left at your death. And if you could just give everything away on your deathbed and have nothing left at your death where they're not getting any tax, they're going to be concerned about that. So the IRS also keeps track of everything you gift during life, and it goes against the exemption that you have left at death. So the tax at death is called the estate tax, and there's an exemption from estate tax. And the tax for lifetime gifting is gift tax, and there's an exemption to gift tax, and they're tied together. So as you gift during life, you use up what you can transfer at death tax-free. Currently, the exemption is $11,180,000 per person. So as a couple, you can transfer double that, which leaves most people in a position to not worry about it. However, even if you think you will never have a taxable estate, there are still reporting requirements to the IRS because the tax law could change. It could go, right now it's slated to go back down to a $5 million index for inflation amount in 2026. So it could be that at some point you will have a taxable estate, and the IRS wants to keep track of what you're gifting. So you have to file a gift tax return anytime you make an irrevocable transfer to somebody else, even if you didn't intend for it to be a gift. So, oh, I just helped my kid buy a house. I didn't actually mean to make a gift. You have to know that you've made a gift and report that to the IRS. What we call free gifts are the times where we don't even have to report it to the IRS. It's the annual exclusion gifts, tuition paid directly, and I'm going to go into these things in more detail, medical expenses paid directly. There are a couple of trusts that the 2503C and the Health and Education Exclusion Trust, I don't see a lot of those, so we're not going to talk about it because it turns out that the administration of setting those up is really not worth the benefit for most of my clients. So that is technically an exemption. You can give to spouses as long as the spouse is a U.S. citizen. And in your packet of materials, your packet says if U.S. citizen or equal or less than, and it's blank because I went to go look up the number and I forgot to go back and put it in. So if you want to write it in, if your spouse is not a U.S. citizen, you can give them $152,000 and not report it. And then you can give to charities, and you do not have to report that as a taxable gift. So you're reporting all of this stuff so the IRS can keep track of it, but you don't actually have to pay a tax until you get to the applicable exclusion amount, which, as I said, right now is $11 million. So as long as you're under that, you do not have to actually pay any tax. You just have to report it. The annual exclusion gifts are currently $15,000 per donor, per donee, per year that you can give to anyone. So while your child is in school, one of the ways to get money out of your estate and help is to pay the tuition directly, because this is one of those tax-free gifts that you do not even have to report to the IRS, as long as you pay the tuition directly. If you give your child or your grandchild money for school, They put it in their account, and then they turn around and write the tuition. You've made a gift to your child. If you just pay the tuition directly to the institution, you do not have to report it, and you have not made a gift that has to be reported. The other ways you can help are setting up irrevocable trusts, which we'll talk about in a bit, and 529 plans, which we'll also talk about in a bit.
Margot, the direct payment on the tuition, since I've been hit with this, also applies to the grandparent paying the tuition directly to USC. Oh, did I say that? For the grandchild. So as long as I pay the tuition directly to the school, that's not part of my annual gifting. Rather than give it to my kids and then they pay, or they're paying the tuition. It's just an easy way, doesn't count, go directly to the school.
One question was, in paying tuition, I'm using the example of kid and grandchild, but does it have to be a child or grandchild to get that tax benefit? And it does not. You can pay tuition for anybody. Again, unfortunately, I'm not Oprah, so I'm not going to be paying tuition for anyone here in this room or any of your kids or grandkids, but I could. I could pay tuition for anybody, and I don't have to report that. And it can be any amount. It's not limited to the $15,000. It's whatever the tuition is. If I am in a situation where I am trying to get some money out of my estate so I don't have a taxable estate, I can prepay tuition. If I know that my child is either started in a school, is going to finish there, or I know that everyone in the family has always gone to this school and they're going to go to this school, I can prepay the tuition, and that actually counts as well. The problem is if something goes wrong and they don't finish school there or they don't go to school there, I can't get that money back. So you have to think about that carefully.
One more interrupt. It also, we mentioned college. You can pay the Pinewood tuition. You can pay the private school tuition, the grandparent. And it isn't a gift. I mean, the parent paying the Pinewood school is part of your support of your child. But the grandparent paying the private school tuition does not count as part of your annual gift plan.
And there are times when preschools and camps can be covered. It's very fact-specific. This exclusion is only for tuition, so the question is whether the preschool or the camp has enough of an educational component to qualify as tuition. Medical expenses, another freebie, where as long as you pay the medical expenses directly, you do not have to report the gift and use up any of your gift tax exemption. So if you have somebody that has medical needs, you can pay those directly. You can also pay for insurance, but something to keep in mind is if that person then gets reimbursed for the whatever expense with medical insurance, that they actually have to pay you back for that, or it does not qualify. The annual exclusion gift of the $15,000, the paying tuition, and the paying the medical, these can all work together with one person. So you can give all of these things to any one particular beneficiary, and you still don't have to report it. There's questions about logistics of, okay, I have to pay the tuition and the medical expenses directly. How am I going to do that? It's going to be a big pain. So one of the suggestions is that you open up an account in your name, and then you put whoever is the beneficiary that's going to be using that for their tuition, their medical expenses, on the account as an agent, somebody that has authority to write the checks from that account. So they're actually taking care of the administrative stuff, but you're on the account and it's going directly to the institution so that you're taking care of it that way. Okay, another tax subject is the generation skipping transfer tax. So we talked about the estate and gift tax. If I left everything, I said, you know what, my child has enough money, and if I give them my money, then they're just going to have a bigger estate and they're going to be subject to tax, and I don't want it to give it to them just for them to turn around and have to give it to the IRS. So I'm just going to skip them and I'm going to give directly to my grandchildren. The IRS doesn't like missing out on that money at the kids' level, so they've imposed another tax, the generation skipping transfer tax. So this is in addition to the estate and gift tax, but it happens to be the same exemption amount, the $11,180,000 under current law. So chances are that, for most of us, we can give freely to grandkids and not worry about this, but for some of us, we do have to think about whether when we give money to either grandkids or So nieces and nephews are the next generation, but the kids of the nieces and nephews would be a generation skipping. Somebody that's more than 37 and a half years younger than us is a skip. If we're skipping a generation, we have to think about whether we have exemption that we have to either use or report. So now we've decided that we want to save money for our grandkids to go to college, but they're not 18 yet, and so how do we go ahead and get that money into an account for them where they someday can use it for college? One of the ways is the Uniform Transfers to Minors Act, where we just go ahead and use this language up here. It's very easy. You go and you set the account up, and boom, you've got an UTMA account that can be held for the child. It's a completed gift as long as if you use your money and you're also the custodian and you die while you still have that money, then you're going to get taxed on it. But if you are, let's say, giving to grandkids and you put it in your child's name as custodian, or you put it in your spouse's name as custodian, if you put it in somebody else's name as custodian, it's done, it's out of your estate, it's in the kid's hands to use for school. It's very easy to set up, so it's easier than a trust. The problem is, with UTMA accounts, when they get to that age where the code says they're supposed to get it, they get it in one lump sum. Default code is 18 years old. 18 years old can be young. That sometimes these UTMA accounts, they're great as we're going along. We're putting our $15,000 in, and we've invested them wisely, and then all of a sudden it's a pretty big amount, and they're 18 years old, and the clients are coming to me saying, well, now what do I do? Because they can't get this money, and what do we do? So that's the problem with UTMA accounts, but it is an easy way to put the money away for college, knowing that, okay, this money is there for you to spend on college, not a Ferrari. So I mentioned that one of the biggest downsides of the UTMA accounts are the distribution and the lump sum at a certain age. And the way you can avoid this is, instead of putting the gift in an UTMA account, is to just go ahead and set up a trust and put the money in a trust. So the money grows in a trust that you say, okay, you're going to get a little, you can use it for college, and then maybe you'll get a certain lump sum when you finish college, or you get to a certain age, and then you'll get a little bit more when you're 30, a little bit more when you're 35. Like, you get to decide how the money is spent, when it's distributed, and what it's used for. So when we talk about trust, there are all sorts of trust. When we're talking about making a gift and a completed gift, we're talking about an irrevocable trust, where we're putting the money in there and we're done with it. It's not ours anymore. And there's all sorts of different irrevocable trusts. This is just some of them. So this is opposed to the revocable trust that a lot of us in California use for the probate avoidance, where we can still do whatever we want with that money. An irrevocable trust, we can't. Once we've specified, okay, this is how the money is going to be spent, this is what you're going to do, that is what you do. One of the things I want to point out here in terms of planning for either kids, grandkids, nieces, nephews, is the pot trust versus the separate share. So separate share is, I have 3 kids and I'm going to set up a trust for each child. And so each child has their trust, and they don't have to worry about whether the other one is going to an expensive college or spending an awful lot of money on ballet and soccer and gymnastics and all these things, because their trust is over here in a separate pot, and they just have to worry about what they're spending. That is generally what estate planners recommend, because we don't want beneficiaries to have to worry about what any other beneficiary is doing. Pot trusts, when we're talking about saving for college or minors or grandkids, is when you have one pot of money and you say, this is what I have to gift, and I'm putting it all in this trust, and it's for all of my grandkids. And that comes in handy because maybe you don't know if that class of grandkids is closed yet. Maybe your kids are going to have more kids. So if you've made your gift when you had 3 grandkids and the 4th grandkid comes along, are they left out? Well, if you had separate shares, one trust for each kid, and now grandkid number 4 comes along, well, they don't have a trust. But if you do a pot trust that says all of my grandkids, it's now or whoever is born, they can share in that money as well. So that's something to think about.
How are irrevocable trusts
Do you want to take this?
So irrevocable trust.
Oh, so the question.
Okay, so the question is, how are irrevocable trusts taxed? And so irrevocable trusts are, they have a tax structure that tax like an individual, only they have their own tax rate structure.
So when you give it to someone and make it irrevocable, does that fall under the gift tax filing rules?
So those are those two different questions. So the question was, once you make the gift to an irrevocable trust, does that fall under the gift tax rules? And that answer would be yes. If the amount that you've contributed to the irrevocable trust is large enough, and then the income that trust generates would generate an income tax.
On the trust as an entity?
Correct.
So the trust would have to file an annual tax return. But remember, you've got an $11,180,000 lifetime exclusion, or $22 million plus if you're a married couple. So I don't have $11 million, I'm sorry. I'm not stressing over giving a larger gift and using part of my lifetime exclusion, because all it means is I've got to file a gift tax return, which is not a huge thing. Just got to gather certain data. It's not a taxable event. It's an informative event.
So I'm going to talk to you a little bit about 529 plans. Margot already introduced the subject, and we talked a little bit about the annual exclusion. So 529 plans is a great way to save for college tuition using gifting. And that's why you're all here, is to understand how to use gifting to your advantage. And saving for college is certainly a goal that we're trying to achieve. So when you put money into the 529 plan, I think of it as a tax-free way to save for college. Essentially, it's a plan that allows you to invest that money for a specific purpose, and that would be the college tuition of the named beneficiary. So you set up the plan, you name someone to be the beneficiary of that plan, and hopefully when they get old enough to go to college, they'll go to college. But if they don't despair, because you can name another beneficiary. You can change beneficiaries if, for example, that first person, your first grandchild, doesn't use all the funds that are in the 529 plan, and you can kind of move that along. So once again, it's a great way to save for college, and you use annual gifting mechanisms to do that. With the annual exclusion, as Margot has indicated, you have $15,000, and so you can put your annual exclusion in the 529 plan. But in order for that plan to grow, some people have a large sum of money now that they want to put into the plan, and so you can actually pre-fund the plan by giving up to 5 years of annual exclusions into the plan, and that would be like making 5 years worth of annual gifts to that person, your child or grandchild, whoever it is that you're saving for college for. And you would have to file a gift tax return in that instance, because you've given more than the annual exclusion for that year, but it will be treated as having that annual exclusion spread out over a 5-year period. Whatever, if you gave $60,000, it would be like giving $12,000 each year.
But it's only for college, it can be for high school.
So that's a good question. So the question is it only for college? And the answer is no. Under the new tax law, you can now give up to $10,000 of tuition for elementary school, secondary school, public, private, religious, those types, as long as it's a college. It's tuition-based payments for that school. Another thing that we wanted to talk about is Roth IRAs as a way to save for college. So if you have your grandchild or your young child that has got that summer job and has earnings, then one way to save for college and to also instill in them being able to save is to help them by contributing to a Roth IRA on their behalf. So the way a Roth IRA works is you have to have earned income, and you can contribute up to $5,500 you're under 50, and your children will assume they're under 50. And you make this contribution, and it grows tax-free, and when you take it out, it's tax-free. And so pardon? Well, you have to hold the plan for 5 years, yes. We're getting way too much in the weeds here. So the plan grows tax-free, and when they're ready for college, you can take it out and they can use it for college. If you are in a tax situation where perhaps your income is lower and you have an IRA, or you have some losses that you can take against your income, consider converting your IRA to a Roth because of the benefits of the Roth IRA, and then that gives you a tax-free vehicle for making tuition payments or for gifting or for doing anything else. The Roth IRA has no required minimum distributions, so it can stay in the account, it can continue to grow. I mean, it's a great instrument for you to lower your AGI if you're taking it out later in life, if you're living on it. But from a standpoint of using that money, it would be a tax-free withdrawal, and so it's a very good instrument that you could use.
Okay, so moving now to, we were focusing on gifting to kids under 18. Now, gifting to adults, what additional opportunities do we have? So we now don't have to worry about giving money outright when we're talking about adult kids. We can just give and put assets in their own name. And the question is, do we want to do that? So once we've given money to an individual in their own name, it's subject to their creditors, and we sometimes think of a potential ex-spouse as the biggest creditor. It's subject to tax if they have a taxable estate. The toothpaste is out of the tube and we can't get it back in. If instead we put money into a trust for them, that we set up the parameters of how they can use it, when they can be trustee, it will have some aspect of creditor protection. It'll have some aspect of protecting from spouses and divorce, kind of takes the prenup discussion, makes that a little bit easier. And it is not generally necessarily taxable in the estate of the beneficiary. So in terms of outright gifts versus the irrevocable trust that we had on that slide of all of the different sorts of irrevocable trusts that we could use, I am a big fan of irrevocable trusts for the benefits that it provides and the flexibility that we can draft into it. Family partnerships or entities and tenants in common agreement I put up here because sometimes in Los Altos I find a lot of people that have properties and they're going to be leaving those to multiple kids, and they want to encourage the kids to keep the properties because real estate in California has been a nice asset for people. But now do you want your kids to be co-tenants and have to work out what the arrangements are between the kids that don't necessarily get along? So you can use an entity and say, okay, this is the kid that really knows what's going on, who's in charge, and he's going to manage the assets within the entity, and the distributions are going to go out to all the kids, so they're going to have the money and they're going to be taken care of, and this is how I'm going to promote keeping this asset in the family. So we can use family entities, or if we don't want to use the entity, tenants in common agreement, to put some parameters around who's going to manage the property, how are the expenses going to be paid, how are the rents going to be collected. Low interest loans, this is not, we're talking about gifting, and this is actually not a gift at all, where we're actually helping our kids to pay for college and buy a house, invest in a business, by providing money to them, but not gifting, because we're saying, okay, we want this money back, but we can do it at very low interest rates. So the rates for October for a midterm note for like 3 to 9 years that they'd pay back, it can be at 2.83%. Chances are you can give a kid money at 2.83% and they can go and do something, get a better return than that. So it's a nice way to get some money over to them. Or longer term, anything over 9 years, the rate is 2.99%.
These are what are called the applicable federal rates, the AFR, and they're changed every month and they're published. You just Google applicable federal or just applicable federal rate, and you can find what the current rates are at the time you make the loan, short term, midterm, long-term.
Yeah, we can find the lowest rate where it's still considered a loan and not considered a gift. You can go higher than that, but assuming that we're trying to get the money over to somebody else and let them use it, we want to find the lowest rate we can.
But if you, as I run into often, if you then say, well, I'm going to forgive the interest, you have to report that income. You've received $100,000, 2.83%. You've gotten $2,830 income. You can forgive that for the child, but you still have to report that income.
Okay, there's a lot on this slide. This is to talk about, what is the best way to give to kids in terms of getting bang for your buck if you are interested in estate tax savings. So cash is a nice, easy gift if we have it, and it makes a nice annual exclusion gift because we don't have to worry about appraisals. We don't have to worry about much of anything other than whether we have the money in our account. But if you are trying to do tax planning, then usually we look to see, okay, how can we get the appreciating assets, the assets that are going to get the value over to the other generation, and how can we do it in a way where we're going to get discounts? So if I have a house that is worth $3.5 million, if I went and sold it on the market and I give my child the house, the entire house, then I have to report a gift of $3.5 million. If I give them half of the house, well, half of a house is not worth half of $3.5 million because who wants to own the house with me or my kid? So I go out and I find an appraiser, and I have to pay the appraiser to tell me what it's worth. They tell me what the house is worth if I sold it, and then they tell me what the discount is for only having a fractional interest. So by doing this, it's the way of getting sort of more over to the kids with using less of our exclusion amount and less exemption. Obviously, the IRS doesn't like this too much, so this is it's completely legitimate, but it's going to be one of those that is going to be flagged perhaps by an auditor to see, did you take too much of a discount? Did you get the right appraisal? To make sure that you really are reporting and paying or using up all the exemption that you should. Something to keep in mind in terms of whether you want to give during life or wait and leave something at your death is that gifts that we make during life have a carryover basis for income tax purposes, and gifts that are left at death that are included in our taxable estate are the income tax basis is adjusted to the fair market value at the date of our death. So we often talk about this as a step up in basis because we're assuming that over time the assets are appreciating. So if that $3.5 million house in Los Altos I bought for $300,000 and I give it to my kid while I'm still alive, they have a $300,000 income tax basis. If they turn around and sell it, they have capital gains of $3.2 million. If I wait until I die and I give them the house when I die, it is adjusted to the fair market value at my death, so 3.5. They get it. They could turn around and sell it, and there's no income tax because they sell it for 3.5 and they had a basis of 3.5. So that might sound like a reason for holding on to things, but much of what I do is spend my time on, well, if I had given some of it during life, I could have fractionalized it, and now when that house is not 3.5 when I die, but $5 million when I die, wouldn't it have been better if some of that had been over at my kids in my kids' name and not my name? So balancing those estate tax planning versus income tax planning considerations. So if you're gifting securities, you might want to get some money to your kids, but you don't necessarily have the cash in the account, and you have some stock, and you want to just go ahead and give, we call it in kind, you actually give the stock. The stock is also going to have a carryover basis. It's going to be whatever your basis is now going to become their basis. But something to keep in mind is that you can actually pick and choose. So if you have a lot of holdings on something and you have some low basis and some high basis, you can pick the higher basis stock to transfer over to them, but you just have to know to do it at the time that you're making the transfer. You can't say, oh, it's time to report the taxes, and I meant to take that stock. It's too late. So child wants to buy in Los Altos and you want to help them out because it's really expensive to live here and buy a house here. So how do you do that? You can go ahead and just give them the money and then they go and buy the house. You can instead put the money in a trust for them, and then the trust buys the house either completely or with them, so that those protections that I mentioned from then it's not included in their estate, it's not subject to their creditors, it's not subject to their spouse making a claim against it. So you give the money to your kid, and your kid goes and buys the house with spouse, and then they put community property. Well, then you get they get a divorce, and you watch that money that you gave to your kid go into that spouse that you don't really like so much anymore. If you had put it in a trust, it would have been better protected because it would have stayed separate property. The co-ownership issues are, my kid needed help getting a mortgage, so I bought the house with my kid. This is important because this is where I have then the clients come in years later and say, now how do I get off of title? And it's a big mess because maybe they ended up as joint tenants when really they only contributed to the down payment and the kid's been making all of the payments. And so what are they really gifting now? When you go to get off of title, you're making a gift because you're irrevocably saying, I'm not on this property anymore. And if the title was taken as joint tenants, which we find a lot of times that's how it's taken, joint tenants presumes that you have an equal ownership. So if it's you and your kid, the presumption is that you have a 50% interest. Then that presumption can be overcome by showing, oh no, I only paid $100,000 on the down payment and helped the kid get the mortgage, but they're the ones that made all the payments, and deal with that. So if you're about to get into that transaction, I'd suggest calling your advisor because there are things we can do like a holding agreement where we just say, okay, I'm helping you get this house and I'm going to go on title, but I might be on title right now for 10% because I'm helping you with 10% of the down, I'm helping you with the down payment, but really you're going to be making all the payments, so every time you make a payment, I'm less and less and less of an interest, so by the time I finally get off this property, it's not 10% anymore. If you have a holding agreement that spells all that out, that's much better documentation, and when you go to transfer it and the property tax assessor gets involved, the property tax assessor will actually recognize this kind of holding agreements as long as they were in place at the time that you entered into the transaction. You can't do that after the fact and say, oh no, I never really had that much, I really never had 50%. Don't make me have a change in ownership on 50%. The other thing you can do to help kids buy a house is do that low interest loan that I talked about, is give them some money at a lower interest rate than they could get from a bank. So these things either parents or grandparents can do. With grandparents, though, again, if you're skipping a generation, then you have to think about this slide has the maybe subject to the GST, the generation skipping tax, only on the irrevocable trust. It actually would be on the outright bequest, outright gifts and bequests as well. When you're skipping and helping the grandkids, you are skipping a generation. You have to think about whether you are subject to that tax or using up your exemption. So now instead of helping to buy a house, you have a house and you're ready to downsize and you're ready for your kids to take over. How do you get it over to them? Or you want to leave your house at your death, and you've got 3 kids, and one of them wants to live there, and the other, let's say you have 2 kids, and the other one doesn't. So what do you do to get the one that wants the house to get the house? And what's the most tax-efficient way to do that? So I'm going to talk about property taxes for a minute because this is something that if you're thinking about, I find a lot of attorneys don't even know these rules. I had somebody call the other day and say, I want this property, and the attorney that's handling the trust administration says I can't do it, and you actually can, you just need to know how. So I want to spend some time talking about this. So in the situation where you have, let's say you have a $2 million house and $2 million brokerage account, and you have 2 kids, and one of the kids wants the house. That's easy. The kid that wants the house gets the $2 million house, and the kid that doesn't want gets the $2 million brokerage account. Where it gets messy is you have a $2 million house and a $1 million brokerage account, and one of the kids wants the house. So if the kid that wants the house says, oh, that's okay, I'll just pay you $500,000 and I'll get the house and you'll get the $1 million from the estate and my $500,000 and you'll get 1.5 and we'll be even. The problem is the tax assessor is going to say, well, that's a sibling-to-sibling transfer, and that's a change in ownership. So for property tax purposes, chances are in Los Altos, you have a very low property tax basis and would like to keep that basis, and more importantly, your kids would like to keep that basis, that you want to avoid a change in ownership. So if it's going from parent to child, there's an exclusion from a change in ownership that exempts that from reassessment. A parent can transfer to a child their primary residence or $1 million in assessed value, not fair market value. What does your property tax bill say the property is worth? You can transfer $1 million. So for a couple, you can transfer $2 million. Grandparents can also use this. The problem is that if you want to transfer to a grandchild, both of the parents have to be deceased, or if your child was divorced from the other parent, then that qualifies if your child was deceased, even if the other parent is still alive. So I don't really see a lot of grandparent-grandchild exclusions, but I do see a lot of people trying to use the parent-child exclusion to save the property tax basis. So in that situation where you have the $2 million house and the $1 million brokerage account, and you want to avoid the sibling-to-sibling, so it really is considered parent to child, there's two things you can do. One is if you know ahead of time that you want to do it, you draft your estate plan to say that you're going to give a right of first refusal to a child that wants the house. And if that child then comes and says, okay, I'm going to exercise this right of first refusal and buy the house, even though they're paying the same $500,000 to the estate that then is going to the other kid, it's actually then still considered between the child and the parent's estate and qualifies for parent-child exclusion. It's not sibling to sibling. The other thing is that if you didn't do the planning and now you're in a trust administration and you want to make this result, the trustee can go out and get a mortgage on the $2 million house for $500,000. They take the $500,000 proceeds from the mortgage and give that to the kid that doesn't want the house along with the brokerage account. And then you distribute the $2 million house subject to a $500,000 mortgage to the kid who wants the house. So you can do that as long as the trustee went and got the funding and as long as you're not getting the funding from the kid that wants the house. So
It has to be third-party funding.
it has to be third-party
That's
funding, which is expensive.
Bad case law, but that's what it is.
Yeah, it's silly. So that to try to get that kind of funding, it's expensive. But if you can find anybody else, like apparently even the spouse of the kid that wants the house can provide the money, then you can do that planning. So the best thing is if you know you want to do that, to just get the right of first refusal into your estate planning. Yeah, so the question is, if you are transferring it from the parents' revocable living trust, and now they're saying that they want the property to go to a trust for the kid, for the purposes of these exemptions, you look through the trust to who the beneficiary is. So as long as it's a trust for the beneficiary and the beneficiary is a child, you qualify for the parent-child exclusion. That's a good question because another spot where people get mixed up is when attorneys have tried to draft in flexibility and say, okay, it's a trust for my kids and their descendants. Well, now you have a trust that's for kids and grandkids, and you don't qualify for the exclusion anymore because it has to be parent to child, not parent to child and grandkids. So you want to make sure that your trust is drafted just for child when you want to use that exclusion.
Why would you gift to a charity? Well, there's several reasons. One, you've had a liquidity event. What that means is your company sold, it went IPO, you sold your house because you're downsizing. I run into this almost on a weekly basis where you're downsizing. You're selling your $3.5 million house and you're going to buy a $1.2 million condo. You bought the house in 1980 for $300,000. You've put $150,000 in improvements in the house, so it's $450,000. You've lived there for 30 years. You're going to get a $500,000 exclusion, but guess what? You're still going to pay tax on $2 million. I'm rounding numbers off. $2.5 million. 450 plus the 500 exclusion. That's a lot of money. That's $500,000 federal and another $250,000 state or more, because without going into the whole tax thing. So you may say, I want to offset some of that. Well, the way you offset it is you can make a gift. You can make a gift to a charity. You can do it through an outright gift. You can do it through a donor-advised fund. There's lots of ways to doing it. Coming back to the stock example, you give the appreciated stock. The rule on giving appreciated stock to a charity is you get a tax deduction for the fair market value of the gift. Forget the capital gains, it's forgiven. You paid $1 for the stock, it's worth $10. You give 100,000 shares, you've given away $1 million. You don't have to pay tax on that $900,000. You've given $1 million gift to the charity. Now, that's limited to 30%, because it's appreciated asset, to 30% of your adjusted gross income, but you could carry it over for 5 years, and we just run the numbers. But why? Let me back up to why do you do it? Well, I've been supporting Community Services Agency, Los Altos Community Foundation supporting. I've been gifting to. No waste, total support. CHAC, Women SV, other local charities during my lifetime. I die. They're going to lose my annual charitable contribution. I give to the Los Altos Town Crier Holiday Fund. I die. They're going to lose my contribution. How do I not do that? How do I leave a legacy? How do I make it continue? I set up a donor-advised fund, to me is the simplest, that says, when I die, this is what's going to happen to the assets. They're going to, X amount of money is going to be given away each year to these charities until it's all used up or whatever, and maybe it'll never be used up. There are tax benefits to making the gift. Let me digress again for a second. Had questions before we started. Under the new tax law, aren't contributions limited? No. No. Contributions were actually liberalized. You can gift up to 60% cash, not appreciated assets, up to 60% of your adjusted gross income in a given year to charity. Used to be 50%. Now, if you give away more than 60%, you get to carry it over and use it for 5 years. So, you can move it forward. So, what was limited was taxes. You are limited to $10,000 in state income tax and property tax and DMV. In the taxes section, I'm visualizing a Schedule A. Medical wasn't changed, itemized deductions. Taxes were limited to $10,000. Contributions were a little bit liberalized. Mortgage is the same, no change. Well, new mortgage is limited to $750,000. Old mortgages are still the $1 million. Miscellaneous itemized deductions have gone away, totally. Your brokerage fee, the 1%, unfortunately, no longer deductible. Our fee, unfortunately, no longer deductible. The unreimbursed business expenses, those are typically the 3 categories. Investment expenses, unreimbursed. All those miscellaneous that had to have a 2% threshold, those have gone away. So other than that, we can still give lots of gifts. Now, I'll come back to donor advised funds in a minute. Point out on slide 22, because I'm actually going to reference, they're numbered at the top, in a little circle. Tells you how to, gives you a place you can evaluate charities. These are really good websites. I go to GuideStar quite often when I'm looking, because it'll actually show you the tax return, and I know how to read a tax return, unfortunately. So I can see what what their ratio is for administration. I won't badmouth Red Cross. It's a very high administration. So we want to look at those. outright gifts. You can do appreciated assets I just talked about. Another area is what's called a qualified charitable distribution. You have an IRA. You're allowed now to give up to $100,000 a year from your IRA directly to a charity. It can't go through your hands. It has to go from the IRA to the charity. I think they finally figured out, since this has been around a couple of years, they finally figured out how to do that. It counts as part of your required minimum distribution if you're over 70 and a half, but you don't have to report it as income. And I've had a few clients that have said, that's great because it gets me my income down and lowers my Social Security medical that they take every month because I get below a threshold. So it goes, directly. That's a good, if you're giving to charity, that's a good one to do. You can give life income gifts. Why would you use a donor advised fund? 2 reasons. One, I talked a little bit about the legacy you give during your lifetime. We've talked about helping your children learn about philanthropy. One of Joe's favorite stories is a donor advised fund at Los Altos Community Foundation where the owner, contributor of the donor advised fund brings in the parents and the grandchildren every Thanksgiving. Where do we want to give the money this year? And they all come with their charity and they discuss them and how much and what are we going to do. So they're involved in the giving. And then they give out of the donor advised fund. But the children think about it, the grandchildren think about it. It's just it's a good exercise. Another way, save income tax. We've come into this what we call bunching of your itemized deductions. Under the new law, the standard deduction for a single person is $12,000. For a married couple, it's $24,000. There's no such thing as an exemption deduction anymore. You can have 5 kids, you're still only going to get the $24,000 standard deduction, the larger of itemized or the standard. This was supposed to help people. I don't know how it helped the people that have 5 kids because they were going to get over $20,000 in exemptions plus the standard. Anyway, so let's take an example. Your income, your taxes, as I mentioned, you don't have enough medical to get over the 7.5% threshold. Congratulations. Your taxes are limited to $10,000. You give $10,000 a year in contributions. So you have $20,000. You have $10,000 in taxes and $10,000 in contributions. That's $20,000. You get the standard deduction of $24,000. But what if I put $25,000 into a donor advised fund? Now I've got my $10,000 in taxes, combination of income taxes and property tax, and I have $25,000 in contributions. I have $35,000 above the standard deduction. I get a bigger write-off. Year number 2, 2019, I have my $10,000 in taxes, but I don't make any contributions. I give them out of my donor advised fund. So I don't get any current charitable deduction because I already got the deduction when I put the money into the donor advised fund. So I make my $10,000 worth of contributions out of the donor advised fund. Church is still happy. The organizations are still happy. Everybody's still getting the same amount they get. But I get a $24,000 standard deduction, even though my only deduction is the $10,000 in taxes, no contributions. So I benefit that year. Year 3, I go back to putting money in the donor advised fund and getting above the standard deduction. So we do a little planning here by what we call bunching the charitable giving, which is literally the flexible amount. And I'm sorry, I assumed you'd lived in Los Altos for over 30 years and don't have a mortgage. I ignored mortgage. Or you have a very small mortgage. But you get the principle, you get the idea. As we run the numbers and we look at, can we do some shifting between years and get you below the standard deduction one year and above the standard deduction the other year? A donor advised fund you set up at Los Altos Community Foundation, Silicon Valley Community Foundation, Schwab, Vanguard, Fidelity, Morgan Stanley, Wells Fargo advisors, virtually everybody has a donor advised fund structure. And what you do is you put money into that fund, you get a current tax deduction because it's considered a gift, a contribution, excuse me, to a 501c3. Then you as the donor advise how you want that money to be regifted. That's the donor advised. You tell Joe or Kathy Kameen or whoever at Los Altos Community Foundation, send $2,500 to Jack out of my donor advised fund.
Let me give you a personal
I don't
example.
get a gift at that point.
I had an account that my dad set up for me when I was a kid. It didn't get all used for college. Sitting there, I had no idea what the income tax basis was in the stock. So I was kind of stuck with it, because if I sell it and I don't know what the basis is, my basis is zero, and I didn't want to deal with the capital gains, so it was just sitting there. Meanwhile, my kids are in school, and the schools are always asking for a donation every year, and I'm sitting there writing a check out of my cash, which I need, while I have this stupid stock sitting there that I'm doing nothing with. So I set up a donor advised fund with Los Altos Community Foundation. It is a two-page form. It is so simple to set up. You pick the name for it, you say what you're going to put in it, you let your, wherever the asset is, you say, I want to transfer this over. They transfer it over. Joe says, okay, we received your asset. And then I said, okay, I need to make a gift to the school this year, so, write the check. And so this year, Los Altos Educational Foundation is saying, okay, we need your money. We don't like all this people that are saving on property taxes because we're not getting enough money for education anymore. So I contact Joe. I said, can you write a check from my DAF to make my contribution? They say yes, and then my school wants to know that all of their students participated, so they put a little note. This is for the Bonding U kids at Gardner Bullis, and I've taken care of my low basis stock. I still have the cash, and I've bunched because I put enough money in this year that I'm going to be above the standard deduction, so I can take the charitable deduction this year.
So how much is the limit per year?
60% of your adjusted gross income, including your rents.
Well, that's the limit. That's the limit for the deduction. You can make a contribution of any amount to the DAF.
There's a question, what was the minimum? What was the minimum at Los Altos
But you
Community
should only
Foundation? What's
give
the
what you
minimum?
can give away in a
5,000.
5-year period.
$5,000 is the minimum at Los Altos Community Foundation, so.
And the
take
policy on all of these donor advised funds is Margot gives the stock, it's immediately given to a broker and sold. Los Altos Community Foundation isn't holding the stock for appreciation. It's sold, and that determines the amount of your contribution at that point in time when you gifted it. So again, gifting, you can give during your lifetime. You can gift upon, through your death, after your death. When you're gifting in your estate plan, another planning idea is you want to gift from your taxable IRA. We talked about estate tax exemption, $11 million per person. There is no California inheritance tax, so that's fine. But, where was I going with that? No, but an IRA, not a Roth, a regular IRA or a 401k are non-pre-tax dollars, they're pre-tax dollars. They haven't yet been taxed. So the beneficiary of your IRA or your 401k is going to pay tax on that money when they take it out. But I have charitable intent. I want to leave money to my donor advised fund, I'm looking at Joe, to my donor advised fund so I can continue to make gifts to the Mountain View Los Altos Foundation, High School Foundation, and the Los Altos School District Foundation to continue to support them for my grandchildren. So it makes sense to name them as a beneficiary. For example, in my IRA, because my kids, knock on wood, say they don't want it, 15% goes to each of my 4 grandchildren, and the other 40%, literally drove Morgan Stanley crazy when I did it, goes to 10 different charities. So, I've got 14 beneficiaries of my IRA. But, 40% of it, the kids are under 18 or under. Hopefully I'll live a long time. It's not going to hurt them a lot to get that income. But those charities, when it goes to them, it's out of my estate, because the IRA is part of my estate. It's out of my estate. The charity doesn't pay any tax on it. They're the 501c3 tax exempt. So I support the charity. I don't give the gift out of my other part of my estate, which is a taxable portion. I give it out of non-taxable portion. I give it out of the IRA or the 401k that is a taxable portion. So review your beneficiaries of your retirement plans, see if that makes some sense. And again, you might want to include a donor advised fund in that. There's also, which we didn't go into, other trusts, a charitable lead trust, a charitable gift annuity, other items where you can get a current tax deduction and you can get income during your lifetime, and then the remainder, charitable remainder trust, the remainder goes to charity at your death. When you actuarially calculate it, has to be a minimum of 10%, thank you, Bill Gates, because he set one up that it actuarially went to 0. They said, that doesn't seem right. The charity won't get any money. So they put in a rule that said, actuarially, when you set it up, there has to be at least 10% left, presumably. When, if you outlive the actuarial tables, there may not be. But so there are ways, a lot of different ways to give during your lifetime, benefit those organizations you care about, both during your lifetime and afterwards. We're at 8:36, and I'm going to stop. We will stay around till 10 o'clock. Thank you all very much.
Thank
from
you
all
for
three of us.
coming. We appreciate it. Thank you.